Are we live in the Facebook group? Okay. Hey guys, this is Chris Clothier with another. What am I doing today? Yeah, we're gonna have to do this one again. Hey guys, this is Chris Clothier with another podcast. We are recording the. God, my brain is thinking of all the different things I've got going on in the Big Buffalo. We are recording. Let me start this again. And I'm doing this live in front of the Facebook group. So, hey guys, Chris Clothier here, and we are recording live for a. What is the name of my podcast? Like, seriously, I'm having a 50-year-old moment right now. Jeez Louise. All right, to everybody that's out there on the Facebook group, thank you very much for joining us here today. I am one of the owners of REI Nation, Chris Clothier, and we're getting ready to record a Grind podcast. Thank you for joining us. We're getting ready to have a little bit of fun here. We will get all of our technical everything ready to go. All right, well, let's get this started. This is, before I actually start the Grind podcast, I want to make sure I tell everybody that's on the group that you haven't seen myself as much in the Facebook group over the last 6 months. We've been bringing in some other personalities, some other members of the company, of the leadership, and we really wanted the group to be able to see some interaction from those that run the day-to-day, from renovations to the property management company to just even operations with Ryan Flannery. And it's done us as a company a lot of good to be able to help the members of the group and many of our clients or interested investors get a chance to see additional information and see other people. But myself, Kent Sr., we've been working very hard behind the scenes on The Grind, which is our newsletter and our podcast. And we thought with the topic I want to do today, which we will release to The Grind on Friday, we thought it was really important that maybe we kind of cross these two and let the group see behind the scenes and watch us record this week's podcast, because I think it's super important. It is a topic that's real estate specific, and maybe even some that are watching will want to post some comments and ask questions. So either way, we're going to have some fun with it. We're going to use this content in two different places, let everybody get a chance to watch and see kind of behind the scenes as we make one of our podcasts. Did you say hi? Did you want to say hi to the team? Because you're normally not on camera at all.
I'll say hi from over here.
You'll say hi from over there? Okay, so those of you who don't know, that's Isabella. I talk about her a lot on the Grind podcast. She's awesome, part of the very important marketing team that helps us kind of do what we do. So with that being said, I'm going to go in and start recording the podcast. You're watching. If you have questions live in the group, ask away. I'm happy to answer them on here. I'm going to tell the podcast listeners what we're doing. And look, I look forward to interacting a lot more with everybody in the Facebook group in 2022. So with that, let's get started. You ready?
I'm ready.
Hey guys, this is Chris Clothier again, coming to you from Memphis, Tennessee with another episode of the Grind podcast. This week, we have on deck a real estate related topic, and it's a big one right now. It's something that we are getting a lot of questions about, both from existing clients and new clients. And it's very specific this week to what in the heck is going on? What do I need to be doing right now? What's happening with the market? What's happening with prices? What's happening with interest rates? And a lot of investors they're doing two things that I want to make sure I give some good rounded advice on. Number one, they are becoming stuck, like almost in the mud. Like, I don't know what to do now going forward. I've got a lot of questions. I'm taking what's happening in the current market with a lot of uncertainty. And then I've got another set of investors that are simply saying, I'm not doing anything. I'm waiting until I see what happens because I'm expecting, some major fluctuations, some major differences to occur. And I'm just telling you right now that they're not. I'm not expecting a lot of big, massive movement to happen within the housing market. And I'm talking like drastic price drops or drastic movements in the borrowing rates, either up or down, although they're going to see some movement. I think that there's a lot less uncertainty right now than people recognize. So today I'm going to share 7 reasons why I think investors should absolutely be pulling the trigger right now, why I continue to pull the trigger, why as a company we continue to be buyers, not only in the single family market, but we're also buyers in the commercial market. We are looking to add to our own portfolios as well as add to the portfolios for our clients. So, and I just thought I would go through it after having been, in the market now for 26 years. It was 25 years ago that I bought my first property. Started really, really actively investing about 20 years ago. So I thought, what better time than to talk about this right now, because we're getting so many questions about what do I do in this market? What do I do today? So with that being said, look, for those of you that are taking notes out there, I'm talking about a $20,000 or $250,000 investment property. For us at REI Nation, that's right where a majority of our properties are landing today. We've seen that price point just escalate as prices have gone up, our borrowing costs have gone up, the cost of material has gone up. So we're getting into a period where if we want to stay in what we think is the right asset price, where we want to stay where we're getting the biggest bang for our buck, meaning we're able to control CapEx. We're able, by the way we renovate the properties on the front end, we're able to control demand for the properties because we're buying in the right areas. We're able to control what we believe is going to be a continuing appreciating market. Then we're trying to buy as many of our assets as possible in the best markets, the best neighborhoods. It's really leading our average price to go up. That means we still have a lot of properties that are in the $175 to $225 price range, but we have a lot of properties that are over $300,000 today, and these are fantastic investments. So, for the sake of us talking today, if you're taking notes there at the house, I'm talking about a $250,000 house, and we're going to talk a little bit about interest rates as well. So let's dive right in. Look, the 7 biggest reasons, and I'll break them down as I go, to be buying investment properties today are: number one, you are able to control property today for a fraction of the cost. Now, many of you know that I'm super cautious when it comes to borrowing money. I'm super cautious when it comes to using leverage, but I believe in it. I believe it's a great tool to use to acquire property. And I'm going to talk about all the 30-year advantages of it, although I generally look to pay my assets off in 10. So, with that being said, everybody doesn't invest the way I do. I'm going to talk about the way most investors, approach investing today. You're able to borrow at a 3-to-1 advantage today. So you can take $62,000 and control $250,000 asset. That is a massive reason to be getting into real estate today. Lenders, and primarily these are traditional banks or traditional mortgage lenders, will lend at a 4-to-1 rate. So they will lend you $250,000 and only require you to put, or they'll let you buy a $250,000 asset and only require you to put $62,000 down. So you put 62 in, they're going to give you roughly $185,000 to buy. To my knowledge, and I've been around this a while, I know that there's definitely some things that are advertised on the internet, some different ways to buy different assets, but I don't know of any other asset that you can buy at a 4-to-1 ratio. I don't know of any other assets out there that you can go to a bank today and say, I'm going to use the value of the asset itself as collateral, and I want you to lend me at a 4-to-1 ratio against that. And I certainly would never classify a car as an asset. I had somebody recently try and argue with me that you can do this with cars. So what I'm saying is incorrect. Well, that's not true. That's not cars are not generally a appreciating asset. So when, there's nothing that is a traditional investment style vehicle that you can borrow from a bank legally at a 4-to-1 rate. There's nothing that I know of where the government gives you specific tax advantages to participate in the market. They give you specific advantages, including allowing some of the advantages go to leveraging. If you use leverage, you're able to take some of those costs involved in leveraging and use it against your taxes, specifically tax advantages to real estate investors. I don't know of too many other things out there that combine both the lending aspect and the government saying, hey, we've written a tax code specifically for you to get involved in this market. I don't know of too many assets out there where you have a resident that actually lives in and takes care of that asset to an extent, and they provide you with the funding for the long-term buy and hold. So they actually give you the money that you are required to pay to the bank in order to occupy that asset. And in many cases, you can even squeeze some arbitrage out of that, meaning that you can rent a property for more than it costs you to own that property. So you get to make the difference, the arbitrage. A lot of us call that the cash flow that you're able to make on a monthly basis. At the same time, the government allows you to depreciate the cost of actually acquiring and owning that. So you get to continue to take the tax advantage of owning that property while it appreciates and goes up in value. This is again, many of you, I might be going over something you're like, man, this is so basic. I already understand all this, but you really need to understand in context of what it means for today. The big one, the borrowing rates right now. Borrowing rates continue to be at historic lows. I understand that they're going up. It's called inflation. We are in an inflationary period. The cost of housing is going up. The cost of every single material that goes into that house is going up. The cost of labor to actually build and produce that house is going up. The cost of the bank to borrow money to be able to then lend that money out, and they lend it out to every single just about every single person that actually is involved in building that house, whether it's all the different trades or the person who's the builder that's building it from the ground up, the investor, they lend that money out. Well, rates are going up, although they are still historically low. Right now, rates are, let me get this right, rates today are hovering around 4%. However, if you are a investor, you are going to pay half a point to sometimes as much as 3/4 of a point higher than the traditional borrowing rate. Why? Because you're making an investment. A bank is actually taking a risk on you because you're not going to live in this asset. So you're going to see an investment rate roughly half a point to 3/4 of a point, 0.75 higher. So if rates right now are hovering right around 4, the borrowing rate for an investor is going to be 4.5 to 4.7, maybe 4.75. The last time rates were this low, I have to go back, or I would call it this high, was May of 2019. In October of 2018, the borrowing rate for investors was anywhere from 5.5 to 5.75. So we're just 3 years removed from these kinds of rates. I hear a lot of investors today, and that's where I'm going to kind of start my talking. I hear a lot of investors today, they talk about interest rates. So this is my first really big reason to be borrowing today is interest rates. Interest rates continue to be at historical lows, but I hear a lot of investors, including experienced investors, saying, I'm going to wait. I mean, rates are going up. I want to see where they're going to land. It's getting more expensive for me to borrow. Understand two things are at play here. Not only is it getting more expensive to borrow, but the asset you're buying is getting more expensive by the day. Your dollar is losing buying power every single day. So you want to take whatever dollars you have and get them operating in owning assets now. And you want to borrow at the lowest rate possible, which the lowest rate possible was yesterday, but it's going to be higher tomorrow. So make sure you are borrowing now, even at rates that are in the 4.5 to 4.75, whatever that point is. They're still lower than they were 3 years ago today. They are going up. We fully anticipate rates to be rising by at least 1/4 to another half point before the midway part of the year. And rates may be as much as 1% higher by the end of this year. And if they reach that point where we as investors are borrowing in the mid fives, like I said, 2018 was the last time they were that high. Now, I go back through my charts and I can look and see that really that was the peak of rates back in 2018. The last time they were higher was back just before or right during the crash. Let me go back and pull this rate right there. So the last time that they were up in higher than 2018 was in 2011. Then they were higher, of course, in 2010, 2009, 2008, 2007. We were paying in the 7.5, 7.75, 8% for money back 2006, 2007. So if you're an investor looking at it saying, what's happening with interest rates? The cost of goods, the cost of what you're buying is going up in value. The borrowing rate is going up. It is escalating. Right now, and I've said this before, this is something I was taught this by Jay Scott, by listening to him and spending a lot of time with a guy named Jay Scott, who's a member in the group. I still believe that the most valuable thing of investing today is the 30-year fixed rate. If you can borrow 30-year money today below 5 points, you need to be locking it in and closing as fast as possible, because the rates are only going up. Over the next decade, it's certainly plausible to see rates not falling back below 5. And so if the rate continues to go up, then the simple fact that you locked in at 30 years below 5 is you're going to be, again, look back saying that was one of the smart ones. You got an asset under control over a 30-year mortgage for a lot less than what it cost an investor, say 24 months from now, 36 months from now, 48 months from now. Now, none of us knows what's really going to happen with rates. I'm not going to sit here and act like I'm some specialty protagonist or some specialty, the word escapes me, that can look out there into the future and tell you this is what is going to happen for sure with rates. But I know that if we look back at historicals and we look at the fact that there is cycles that we can follow, this makes sense. Rates are going to go up. Something has now occurred within the marketplace that's going to force rates up. That something, as we all know, is a lack of building over the last decade. That has meant that we are well behind on building single-family homes for household formation, just basic consumption. We're way behind, which means there is this massive pent-up demand. Well, that would tell us that, hey, there's room for prices to come down because demand, they'll just wait. There's a lot of people that have been waiting. They'll just continue to wait, and they'll let prices come back down before they buy again. What we miss when we think that is that since 2012, the institutional buyer has only grown in the number of units they're buying every single year. They are buying more right now than they've ever bought in the past, and they're also buying something they didn't traditionally buy. Today, you've got institutional buyers from all over the world buying U.S. single-family home real estate, and they are even going to that brand new build. They're going to that dirt. They're buying the dirt and saying, I'm going to build an entire neighborhood of rental units. So what should be going to the basic consumption for the everyday borrower is actually going onto the rental side instead, which means that demand for housing continues to go up, even as we are building fewer houses than we have in the past. Demand continues to go up. We're well behind, and now the investor or the institutional investor is buying more of them. So when you look at rates, guys, if you are thinking about buying right now, you need to be locking in your rate at the best possible price. I would even suggest that some form of buying your rate down, that can be risky, but using a small, depending on what the price of it is, if you can use a small amount of money to buy your rate down, you get to take advantage of that lower rate over the next 30 years. Even if you buy it down for 10 and have some form of adjustment after 10 years that can go slightly higher, you're still looking at your dollar having more buying power today than it will in the future. It might not be a bad idea to look at how many points do I have to pay to buy this down. Don't look at how quickly you're going to make that up in cash flow, because that doesn't matter. How quickly are you going to make that up in appreciating value, which is the second big reason. So number one, we talked about inflation. I mean, your buying power is tremendous today. Your interest rates are historically low. We need to be taking advantage of that today and using our buying power to get assets under control and closed as soon as possible. Number two, appreciating asset. Look, don't believe the hype that every city is going up in value and that every location in every city is going up in value. It's not. What you're really seeing right now is that within about 20% of median value and, within about 50% above median value, those price points are going up really fast. That is where you're seeing the fastest appreciation. Also, the markets that are growing the fastest, therefore you've got new household formations, people moving in, migration coming into the cities. That would be Texas. Right now, appreciation is absolutely through the roof. You have so much demand. plus pent-up demand, plus new demand coming from institutional buyers, and not enough newly built assets. So you have this very, very quickly appreciating value. All right. And we try to be at REI Nation, we're trying to be in the right markets on the front end. We're doing more new builds than we've ever done in the past, but we're also trying to really find the best value by going a little bit outside of the normal pockets, picking up houses on the outskirts, on the outlying areas, going into more outer neighborhoods, outer locations. So these smaller cities that are just outside, but still within the MSA. And we're finding great, not only value for the investor, but also for the resident that wanting to live in these houses and wanting to stay for 5, 7, 10 years. There's high demand for really, really good assets, which takes me to that next reason I was talking about. If you're investing in real estate right now, I had somebody ask me recently, they said, I really want to go into the multifamily because of the number of doors under one roof. And I completely understood it. I said, I get it. That is a common refrain talked about buying multifamily. But there's a couple of things you got to be really aware of. That you're seeing big price increase, big rental increases, especially in the A-class properties and even down into the B-class properties. But the average stuff that the investor's buying today, the 2 to 4 unit, the 4 to 8 unit, the 8 to 12 unit, these aren't A-class properties. These are and they're not the ones that are going up in rent increases the fastest. You also, when you buy multifamily, the resident, our experience tends to be more transient. They're not the long-term resident. You might be able to get 1, you might be able to get 2 years out, but traditionally you're not going to get longer than a 2-year stay in a 4 to 12 door unit, and you're not going to get the same high rents. So if you don't have the length of occupancy and you don't have the rental increases as quickly as you do in the single family, especially the medium price value homes, well, now you're looking at, does it make sense to buy a multifamily, or does it make sense to buy multiple single family homes where I can have a resident that wants to stay longer, and that resident provides the capital for me to have the long-term buy and hold? Again, some of this is nuanced. Some of this is going to be subjective. Some of this is going to be like where you're buying and what you're purchasing. But for me, I've always found that my the best bang I get for the dollar I spend is going to be finding a resident in a single family home and getting as many single family homes as possible rather than buying a multifamily unit. And believe me, we've looked all over at the multifamilies. It's not something I want to own as a long-term asset because I believe I get greater value for the dollars I'm spending by buying single family homes. Now, all that changes the higher up you go and the nicer the asset. You're buying these, 400 unit Class A multifamily properties. We're talking a different story there. We're also talking a different amount of capital you need. But the fact that you can have a resident give you the money through their monthly rent to fund your long-term buy and hold is a massive reason to be buying today. Lock in your interest rate, get an asset that's appreciating, get a resident in there that's going to give you the money to hold it long-term. The government is going to, well, hang on, before we go there, let's go to the banks real quick. So again, we already talked about it earlier. The fact that a lender will give you basically 3 times your money. So if you've got $62,000, they will give you 3 times that, $180,000 to buy a $250,000 asset. That is absolutely amazing. Now, you need to make sure that you can fund that. You need to make sure that you have the ability to pay should you ever have a vacancy. I want to make sure that people are making smart investments. I've told you many, many times, I'm not a huge fan of long-term leverage. I love the flexibility of having a 30-year note, but I prefer to pay them off early. Even in today's inflationary period, I will still pay my notes off early. I get it. I'm borrowing money. I just told you, cheaper than you're going to be able to borrow in the next few years. Well, if I pay it off in 10 and this has gone full cycle, I might be in a same borrowing period 10 years from now. I dollar cost average. So I will do the same thing 3 years from now. If we're looking at rates in the 7s 3 years from now, I will still be borrowing that money on a 30-year note and trying to pay it off in 10. Okay? And by that time, maybe I've got flexibility, pay the more expensive note off first, but I try not to get myself confused. I try and buy things and I position it in such a way that I want to pay this off in the shortest amount of time possible. If you've read my book, The Turnkey Revolution, this is I'm big on this. This is the way I look at it. But I still say that if you have the opportunity to buy more than one asset with your money, you need to. And today, through smart leveraging, you can buy anywhere from 2 to 4 properties for the same price as you can borrow one with cash. And so even if it means buying cash and refinancing later, refinancing possibly into a better rate, I don't know, but that's certainly something you can look at. It's certainly something that I think investors should be looking to do. One of the greatest, I think, advantages to buying real estate is the fact that the government has specifically written the tax code for us to invest in real estate. Why? Because you've got a very expensive asset, number one. It's a massive driver of the economy. I mean, you've got so many different things that it touches, from distribution, transportation, production, manufacturing. Then you've got all the different trades, from electric to plumbing to, you've got your bricklayers, you've got I don't even know what the trade is called that pours concrete. But I mean, again, you've got the roofing company. I mean, you've just got so many different people. Often there are hundreds of people that actually work on houses. I know that we have dozens that work on houses when we buy something that we're going to renovate, not build something from the ground up. So again, it's just a massive driver for the economy. And a lot of the economy is built on new house formation and basic new home consumption. And so, look, the government wants us to invest our money back into the economy, things that drive the economy. So they have written specific tax advantages for us to be able to buy real estate, wanting us to do that. If you're listening out there today, and you, of course, if I know that we got so many people watching on the Facebook group, write your questions in, write your comments in. We'll come back and our team will answer them. I'll answer them. If you have specific questions about, the lending or the government tax advantages, it's different for different investors. Not every investor is the same. And it's going to be different for each of us based on, what our tax filing looks like. But my point is that it sits out there for us from the government as, hey, we want you to take advantage of this. We want you to get involved in the housing market. And now I'm going to come around to the kind of what I think is the kind of the cherry on top of this. And it's probably the most important part of it. And that is buying the right asset so that it is predictable both in cost and outcome. So for years, I have bought, a plethora of different homes and different investments. I have bought the cheap crap and lost. And you guys know that. I talk all the time. In fact, I know, get ready because we're going to do another deep dive into what does it mean to buy cheap crap as a real estate investor. It's something that we've been asked a lot of questions on the grind here lately. So I'm going to make sure that I answer those questions for you guys. But, if you're buying the right asset, and I suggest that you stay as close to median value for an area as possible, because you know that you've got demand on both sides. Median value meaning that this is where the middle ground is, that there's assets bought below and there's assets bought above. Traditional median, you're going to have more assets that are at the lower, below it than you do above it, because, the prices above median value tend to run up really, really quickly. But my point with that is that don't buy just anything. Don't just go buy some property and say, I'm going to buy this one because I've been told that I need to buy real estate and I want to get my buying power in now and I want to get my dollars working for me, but I want to buy as many assets as possible, so I'm going to buy something really cheap. Not right now. Not today. In this environment, when you're borrowing money at these rates and the rates are only going up and the asset values are going up, if there should be a correction where prices begin, you see borrowing rates go up, but demand comes down. And so prices start coming down. So you're still paying high money, but you're able to get more assets because the prices are coming down. Look, the first price points to really crash, and you can go back and look at 10-year historicals. And I'm just going to take Memphis, for example. It's the lower end properties that tend to sell for the same price every single decade. And I'm talking the same price on the low end. It's the lower end properties that if it sold for $30,000 as a new build back in the 60s, it sold for $30,000 at some point in the 70s, 80s, 90s, the 2000s, the 2010s. And always in between there, you see these run-ups in prices, and then it runs back down. These run up in price, and it runs back down. And this time around, it's run up even higher than ever before. Stay away from assets that yo-yo like this. You're looking for, even if there is a price correction, you're looking for markets and assets that there may be a slight correction, but it's not these real big swings up and these real big swings down. Right now, buy that asset that is right there in the median, in the middle, meaning that people want that. There's always demand for it. It's not feeling these huge price fluctuations. Yes, right now, I do believe that there's going to be some, I'm going to use the word irrational for a second, some irrational run up in price. You know, there's this need to get into the house, but it's coming from demand. It's not coming because we're doing, no documentation liar loans. I mean, that stuff is of the past. We no longer have people buying houses in the name of their dog and, getting approved for it. If you've watched the movie The Big Short, that's one of the great scenes in it where a guy, has bought an investment property in the name of his dog. That's not happening. That was back in the 2004 to 2007. That's not happening today. Today, the run-up in price is because people want these assets to live in and to invest in. And this is when you want to make good, smart, rational decisions. Don't rush to the cheap stuff. You don't have to buy the most expensive thing. Buy at that median home price value, and you'll get the greatest bang for your buck. On our side, as far as REI Nation is concerned, we are able to deliver the most predictable outcome in cost and the way it's going to operate because we buy that median priced home and we do the work that is the same all of it. We know what it takes to provide a high quality asset to the owner, but a high quality experience to the resident. And so when we're able to predict what CapEx should be, when we're able to predict how often you will have a move out, for us over a 10-year period, we're able to show pretty damn accurately how a $250,000 investment that you put 25% down on at 4.7 or 5.2 or 5.7, and 2 years from now, how is it going to perform? And what you want is predictable and reliable. That is not available everywhere in the real estate market. Don't mistake anything I'm saying. You've got to be smart with what you're buying. I'm not telling you REI Nation is the only company that can do this. Not by far. Not at all. But I'm telling you it's what we have sought over the last 2 decades to really perfect. And we're not perfect yet, but that's what we're trying to perfect. We want to be excellent at buying the right asset with the right amount of risk, with the right amount of leverage so that we can deliver a predictable outcome for the resident and for the owner. Really what you're looking for today is, as the owner, is you want that predictable outcome, whether it is appreciation, some cash flow, growing cash flow because rents are going to grow as we keep a resident in for 7+ years. That's what you're looking for. And right now, with so many investors saying, do I wait? Do I continue to build? What's going to happen next? Are the prices coming down? When's the crash going to occur? I'm just telling you that the best time to buy is today. It's not to wait. I'm not telling you that you need to rush. I keep that same piece of advice I always put out there. Do your homework. Be patient. But if you have already done what you need to do, you prepared yourself to buy, you want to build a portfolio, you want to grow your portfolio, look, right now you're just dollar cost averaging. You're getting the cheapest rate you can because money will be more expensive in the future. Buying the best assets you can because it will be worth more in the future if you stay in this right little range of median home value, fixed properly, managed correctly, take advantage of what the government wants you to do, take advantage of what banks are willing to give you, and build that portfolio. Guys, if you're joining me here on The Grind, that's my longest podcast yet. Again, it seems like I'm getting longer and longer and longer, but I'm trying to bring real value. Couple of things. If you haven't already subscribed to the podcast, but you're listening, thank you so much. I'm just blown away by the fact we've got, I think it's almost 8,000 subscribers now that subscribe to all of our newsletters, the podcast. It's just absolutely amazing. But we're growing by almost 1,000 a month. We launched this right at about 6 months ago. So it's absolutely amazing. Thank you so much. If you haven't already subscribed, do it today. If you haven't liked it and shared it, I would greatly appreciate it. All the emails that you guys send me, I appreciate. All the comments you make on our, whether it's on our YouTube channel or on our podcast channel, we appreciate. We're trying to answer the questions you've got for us. And so look, man, we just appreciate all the interaction. Until we meet again here on the podcast, make sure you commit to the grind. Thank you so much for all the support, and we will see you soon.